Alrighty, guys. So welcome to tonight's class on when to hedge your positions, profiting when markets are pulling back. All right. So this was a really important topic for the past few weeks here because we had a big climb in the markets. Markets were climbing higher. A lot of members, we had some members that took their account from 3,000 to 30,000, 9,000 to 100,000, and so forth and so on there. A lot of gains were made during that breakout momentum cycle. But here's the thing, not a lot of people know how to hedge their positions for when the markets pull back and go against you, because the most important thing is to be able to hedge your positions, protect your portfolio on a shifting market cycle. And in tonight's class, that's what I want to go over with you guys. How to protect your account, how to hedge your account with when you have calls, your long positions, how do we hedge that account when the markets are having a quick pullback down to support? Okay, so let's get tonight's class started. And like I said, at the end, we will open up for a couple of questions in the trade room. All righty. So first things first, guys. So you guys know the trade cycle. You guys know the trade plan. You know that we have breakout momentum, we have breakdown momentum, and we have the no trade zone, which is areas of consolidation. So let's say you guys know that our elite yearly members here with us, because you guys have had a class with us, when we're changing from cycle to cycle here, we're getting that first swing trade for 6 months out until Expo, right? So in this example here, we're going to go over our latest breakout momentum cycle that's forming. So let's say here we're bullish on the markets. We get our trade plan confirmations. We have our 3 check marks and we buy some SPY calls on initial breakout momentum bomb cycle. Okay. Our buy date on this example is going to be July 7th, 2020. We'll be buying the 310 strike calls for 6 months out till Expo. Okay. So right here, we could take a look at this. Over to the left, you could see this is an example. This is actually the SPY daily chart here. So this is a 3-month daily chart on SPY. And you could see. Now, if I could zoom out of here, you'll see that this breakout momentum continues all the way back. But I just wanted to show you the most recent one here because obviously, a lot of people are going to be getting into trades within the middle of that cycle. Okay, so that initial breakout momentum cycle was way back in March when we were climbing off those lows from COVID. But here's our initial one here from the latest breakout momentum cycle and phase. We got the 1020 cross, we got the MACD, and then right here on July 10th, this is our confirmed entry for a re-entry into some SPY calls. So the stock is right between 310, 320 a share. So in this example, we're going to go over the 310, and this is deeper in the money than we should be. We should be buying the 320s, but I want to go over this example with you guys. So you're buying the SPY January 15th, 310 calls, and on this date, this is July 10th right here on this arrow. That's where you're buying. And you can see this entry is going to be for $26 a contract on this new cycle that's forming on SPY. Okay, so to the left here, you see the SPY daily chart. And then to the right, this is the SPY January 15th, 310 call. So when we have that initial climb here again, you're getting something for 6 months out till Expo. So from July 10th, 6 months out is going to bring us to the January monthly Expo. So be on the safe side with our swing trades. This is the strategy I love to use and what's really going to help you guys tremendously going forward here. So you see you have that breakout momentum cycle forming here. Entry date on July 10th. And then what you're looking for here is that continued breakout holding above that 1020. Okay, so the SPY 310 call, $26 a contract. Now you guys could see when you got into that trade, SPY continued to break out. It was a great trade. You're still in that trade. And your contracts ended up going from $26 a contract all the way up to a high of almost $57.50. Okay, so we got up to about $57 a contract, right? So you paid $26 for it, and it got up to $56. That's 115% net gain right there, just from 26 all the way up to 57, right? 57, divide that by 26. That's 119% gain, close. 119% gain. But here's the problem, guys. What happens when you see that SPY chart right like this, and you see that big red candle forming, and you see that big retracement here? Well, first off, we're going to learn how to take advantage of these pullbacks and how to profit on the downside and on the upside from them, okay? So this is going to be a really important class for you guys. And like I said, I'm going to make this as simple as possible. And then if you have questions at the end, we're going to open it up to Q&A. Okay, so we just went over that, buying our SPY calls and for the January 15, 2021 Expo at $26 a contract, right? Now, trade started off great. We were looking at it, as you can see, for the next couple of months, it continued to climb. It looked great. Those SPY calls were taking off. They made us 119% gain all the way up to the top there, right? So the trade starts off great. The calls are making us profits. Everything's looking good until the market pulls back to the support areas. And that's usually when all the panic starts to begin. Okay, so in this next step here, first thing I want to do is help you guys understand the importance of support, resistance, consolidation, profit, and stop areas. So if you could take a look here, on every single trade that you're initiating, I want you to be able to draw lines on it just like this. So here was your support lines as you were coming down from breakdown momentum, right? So these are going to be your support lines, and then they're obviously going to, when this market turns, shifts higher, they're now going to become your resistance areas. So now when you got that 1020 cross, I should have had this support too over here, but I wanted to show you guys the importance of that right here. So as you're coming down, here's your support areas. You got base support right here at about 225. You got your next resistance as you start to climb at 250, and your old support is now becoming your resistance. So I want you to see why we say, okay, we're going to trade it up to resistance number 1, resistance number 2. Here's support 1, 2, and 3. And it's just areas where you see some consolidation, you see a failure to break above it, and that could be a strong or a weak support or resistance area, depending on how long it's failing to break above those areas here. Okay, so it's really important on all your trades to find your support and resistance areas, because when the markets do shift and pull back, that's how we're going to be looking for those setups there when markets are pulling back, and looking for those profit areas on those short-term SPY puts. So that's support and resistance. And then here's areas of consolidation. And as you can see, here's that July 10th, right when we got in, right? Let me see if I could annotate on this while I'm here. Oh, this is great. Okay, so here's that 1020 cross, right? Here's that MACD cross right here. And then here's your first green candle above the 1020 SMA. So we got our 3 checks, right? There's our 3 checks. Now, our consolidation areas are just simply areas where, the stock's just consolidating after a big run. Okay, so that's usually when the stock, you can see the candles here, they're trading side by side for about a week here. And that usually happens for a while. There might be something in the market that just causes the markets just to hold off for a little bit. They're waiting for some type of news to come out, a catalyst, whatever it may be. It's important to understand your support, resistance, and consolidation areas. So as you can see, once you break those consolidation areas, then you're having those next nice climbs higher there. You're breaking consolidation, you're having those big runs. And that's what we're focusing in on as momentum traders, are these breakouts, okay? During consolidation areas, these are areas that you want to stay away from the market, or you're going to be looking at different types of sectors to be trading. Because right here, SPY, there might be either tech stocks that are taking off, consumer staples, it could be anything. Transportation might be taking off now with the economy picking back up again, so you got to be looking at that heat map that we go over, okay? But first and foremost, like I said, it's really important here to be looking at those areas of consolidation. Once you could identify those, then that's when you could find a breakout. Okay, if it breaks above this area of consolidation, that's where I'm going to be buying. So during that mid-cycle, that's where you could be buying a new trade and entering into some new calls. You know, you could be entering into some new calls, take advantage of that quick week there, and then make a quick 150%, 200% gain just on a quick short-term swing trade on those SPY calls. So that's why it's really important for you guys to understand consolidation and when you're going to break out of consolidation or break below consolidation. Because if you break below consolidation here, you get that red candle below, then you're going to be looking down towards that next support area for your profit on that SPY put. Okay, so that's why it's always important to be following the market. I tell you guys, hey, if you're in swing trades, don't worry about what it's doing intraday. You know, intraday is going to be for your day trades or your short-term overnight trades. All right, so let's get on with this. So now that you know your consolidation areas, your support and resistance areas, the next obvious question here is, when are we going to hedge against our long calls? Okay, and the importance of this is we want to protect our assets, we want to protect our profits, we want to protect our account, and we got to make that happen by protecting ourselves with hedges against our long calls. Now, obviously, we only want to be protecting our account and making these hedges if we have calls that are longer than 30 days out until expiration. Because if you have shorter than that, then obviously it just makes sense to sell those calls, lock in those profits, or take that small loss before moving on to that next position. Okay, so it's really important, if it's 30 days out or more until expiration and you're still bullish on the market, but you're seeing some type of news, some type of event that's going to bring back the market short term back down to that support area, then that's the proper time to hedge. Now, how and when to hedge with our trade plan, right? So now I'm going to be going over with you when and where are we looking for these hedges and how do we identify them? And the simple answer is the first candle that's below the previous candle's body and wick. Okay, so as you can see right here, here's three areas, if you're in this SPY call from going all the way back to March here, of areas that you could take advantage of. Okay, so as you can see here, let me bring this up. As you can see, look at the size of these candles right here, right? Here's a big SPY candle. Here's another one that was forming, and then you had that big drop. Here's another one back up here after that big run that we had. Okay, so when you're seeing that big run, that initial run, and then you're looking at those retracements, the first candle that's below the previous candle's body and wick, like right here, we ended below that wick and that body on this candle right here. So this is going to be an area right here where you hedge. Okay, and then you're going to be taking advantage of that short-term pullback down here, back down to that support area of 300. So when we pulled back down to that support and we held that 300, right here is going to be the area that you're covering that off. When you got 1, 2, 3 candles here that's holding that support area. Okay, so when you're holding that support and you see, okay, SPY's failing to break below that, you got a successful bounce off of support there. So that's what you're looking to take advantage of. From this candle right up here, all the way down to here. From this candle up here, all the way down to, you see how we're holding that support. And we were talking about that last week. If you guys remember, I said 333 support. And you could go back on the YouTube videos, you could go back on the Zoom meetings. I said, guys, it looks like we're holding that 333 area really well. Okay. Now, the important thing is, you guys remember last week in our trade challenge account, we took advantage of this pullback here. And what I'm going to be showing you guys now is for the September 16th Expo. Obviously, last Friday, September 11th Expo's expired, so I wasn't able to plot that on the chart that I'm going to be showing you guys now. But if you did get the September 11th on this entry here, which this entry here I believe is September 3rd. It's going to show on the next chart here, but this is what I want to show you guys, how successful these short-term hedges are for your account, okay? Because let's just do it now. Get over to that. So your hedging areas are your first candle that are below the previous candle's body, wick, and they're usually much larger than the previous bodies, Okay, so you can see this here, that's 4 or 5 times the previous candle. Here too, this one here is about 3 times the previous candle's body. This one here is about 3, 4 times the previous candle. Big breakdown there. So that signifies, when you see those larger candles, that signifies more volume coming in, more sellers coming in. So when you see that, you have to take that opportunity to get those short-term hedges against your long-term calls here. Okay, so let's go on to the next thing now. So again, when to hedge against your long calls. We're doing these hedges to protect our profits, protect our assets, protect our account. Okay, when and how? First candle below the previous candle's body and wick for longer term trades with 3 months out, or I'm sorry, 30 days out till Expo or more. So this is the most frequent question I get asked. What size of a hedge do you make? Okay, and I hate saying that in the trade room because the new traders that are in there, obviously, you know, you'll get some of them in there that have no calls or anything, and they'll just pick up a SPY put that's a hedge, and they have nothing to hedge it against. Okay, so you guys are the elite members here. You're the yearly members, so it's important to know this. Generally, a hedge is going to be 25% of your long position. So for example here, if you have a $2,000 trade in SPY that has longer than 30 days out until expiration, you can then utilize the hedge on the first retracement like we just went over, when you have that candle below the previous body and wick to hedge those calls. So 25% of a $2,000 trade. So if you have $2,000 on call, SPY calls that don't expire until January 2021, then 25% of that $2,000 trade is going to be a $500 short-term put hedge. And that should be a great, you know how they usually say, you know, about 7% of your account into a trade. This is generally a great rule of thumb here for hedging. 25% of your longs against your hedge. So you got $2,000 call, you're putting $500 on that short-term hedge. Now, we just went over this, right? SPY pulls back 7% in this example right here, right? So from these highs of about 359 down to about 330, 333. So let's say from 359 down to 333. 359 minus 333. So 359 minus 333, that's 26. 26, divide that by 359. That means we pulled back 7.2% from this high right here down to 333. So SPY pulled back 7.24% from here to here in the matter of 5 days. 1, 2, 3, 4, 5. So for 5 days, SPY pulled back 7.2%. That's a heck of a pullback there on SPY. Now, it's either one, your long calls, you're going to lose a lot of value in those long calls. And we're going to go over that in a second here. I want to show you guys something. But you want to take advantage of this. You're seeing some really good selling pressure coming in. And if you're still bullish on the market, you could say either one thing. If I'm still bullish on the market, then I'm going to make a short-term hedge trade and trade those SPY puts back down to support at 330. Or B, I'm going to close out these long calls on that first candle below the previous candle's body, especially if you have calls that are less than 30 days out. And this is an important topic to talk to you guys about right now, because let's be honest, you know, we don't make a ton of trades that are longer than 30 days out. So if you have that first candle that's showing signs of retracement and it's less than, you know, 2 weeks out till Expo, you got to get rid of that. You got to lock in those profits on that big run and stop playing around and hoping for the next day for it to climb. Because it's either one of two options you have during that first candle that's below the previous candle's body and wick. It's either one, you're going to hedge against your long calls, or B, you're going to sell your calls and lock in the profit and wait for the market to pull back down to support and then get your next signal with our trade plan. Okay, so that's really important there. And obviously, if you have something that's, you know, 3-6 months out till Expo, you want to hedge, take advantage of that short-term pullback, and then you could either add back to your SPY calls, or you could close them out, or whatever it is you want to do with them. At least you're profiting from this pullback short-term in the market here. Okay, so those are the hedging areas, and the whole point of hedging is to take advantage of these pullbacks. So here was the entry for one hedge, here's the exit. Here's the entry for the other hedge, here's the exit right here. And then here's the entry for that hedge, and then we have the exit right here. Okay, so now let's go over a little bit further in detail here. Okay. So your long SPY calls you initially paid $26 for got up to $56. So that means you were up 115%. We used the example 57. It got up to 57.20 some, so about 119% gain on those calls. And then you got your first signal, your first sign of that pullback. So you made a short-term SPY hedge and profited 140% on that hedge as your long call pulls back from 56 down to 35, a pullback of 37.5%. Your goal with the hedge is to protect your long position during a short-term retracement back to support areas. Okay, so now if we take a look here, take a look at this example that I made, and this is what I was doing while, I was telling you guys I was in the trade room here. So during these areas, 9-3 here is this candle right here. So if you see on September 3rd of 2020, we had that first signal of a big candle pulling back from those highs here on SPY, and you could see that retracement well below the body, the candle, the wick, everything. So this is going to be your first entry. And if you guys remember, this is exactly when we made those short-term SPY puts last week, and we ended up profiting really nicely in the Trade Challenge account with those. Okay, now, so on September 3rd, that's your entry for those SPY puts, right? So if we come over to the right here, you can see on 9-3 on this candle right here, this is, I could show you guys once we're done here, but down here, you'll be able to see this is 9-3 candle right here. So you could see, obviously, we're not going to get in at $3 or $4. Let's be realistic. Let's say we got in at $5. That's probably right in the middle of that breakdown here throughout the day. So, because she came all the way down to the 20 on that day. So we're probably right at about here when that's at about $5 a contract. Now, here's the thing I was telling you about. This right here, this is for the September 16th Expo, okay? So I wasn't able to show you guys the September 11th Expo because obviously that's already passed. September 16th is tomorrow, so I was able to show you this on the chart here. If I was able to go back to the September 11th Expo, you'd see that these options were much cheaper and they had a much larger pop on that retracement because on that short-term pullback here, the delta was much higher. There was not a lot of theta built into that premium there, but with that volatility, the implied move brought those option premiums much higher. So if I was able to show you guys what you really would have gotten here instead of the September 16th, you would have gotten the September 11th, because remember, this trade is on 9-3. So on September 3rd, that's when you're entering into this SPY hedge for $5 a contract. That's right here, $5 a contract. So now you're saying to yourself, okay, well, if you got the September 16th, you got plenty of time. You got, 2 weeks until that expires. Usually you want to do 1 week expo out on a hedge. But like I said, since September 11th already expired, I can't pull that up on the chart. But if I was able to, you'd be able to see that would be over a 400% return, almost a 400% return on that short-term little pullback here for those few days. Okay, so from 9-3, that's this candle right here. That's when you're entering into that put hedge and taking advantage of that short-term sell-off. Now, if, like I said, you got that $2,600 trade that you made right here's that 1020 cross we were talking about, here's that first green candle, and then you had the MACD, it's hidden in back of this hedge, makes 140% gain, but you have your 3 check marks for your confirmed entry for your calls. So your calls are making money as this continues to climb. If we show you the next chart here, I'd have to exit that out there. But if I show you that next chart, you're going to be able to see the value again of these SPY calls that we picked up. Okay, let me get rid of that quick here for you. So you're getting into these SPY puts at $5. Let me just go over this chart here with you before we move on to the next one. You're getting in for $5. And then guess what? You're dropping, you're having a big gain. This went all the way up to 17 bucks here just in 2 days. So from 5 to 17, 17 divide that by 5, that's a 240% gain on that SPY put for the September 16th expo. Now, the same thing for the September 11th was over 600% from that entry to that date, but I wasn't able to pull it up there. But if you look at our trades that we made, you'll be able to see exactly what we made and what they got up to. So this from right here entry at $5 up to right here at 17 is a 240% gain on that SPY hedge. Okay, now even with the small $500 trade, just one single contract, you turn $500 into $1,700. You know, that's a $1,200 net gain. And that's going to help you, those profits, on that pullback from your long calls. So now let's do this, and let's look at the next slide here. So that little trade, just by buying that on 9.3, as soon as we break below that body and that wick there, you're buying into that SPY put for a week out. If you have calls that are longer than 30 days out and you're still bullish in the market, you're buying a short-term SPY put on that first signal, the first candle below that previous candle's body and wick. And what you're doing, you're buying the shortest term SPY put or whatever it is you're looking at or trading, and then you're buying that week's expo or, you know, that next week's expo. So you're buying that next week's expo, the SPY puts for that retracement. If you're bearish and think, okay, you know what, the markets are pulling back here and we're going to continue to pull back ahead of the election, then obviously you're going to be selling your calls and buying the SPY put there. Okay, so instead of being a hedge, it would just be a regular SPY put that you're entering. But if you're still bullish, like we were, that's what you're going to be doing with your trades, is buying and protecting yourself on the way down on that retracement back down to that 333 support we were talking about. So that's really important. This little SPY put is making you 140% gain while, let me take a look here at the next slide. So that is protecting those long calls. As you could see now on this next chart here, we're going back and we're looking at those SPY 310 calls that we were talking about. So those 310 calls that we picked up for $26 a contract, well, heck, they got all the way up to $57 here, right? They got up to 57 bucks. So from 57 all the way down to, this is saying from 53. I went to this day here. I was talking about this day was at 53. But from the highs there, from 57 down to 35, 57 minus 35 is 22. Divide that by 57. That's a 39% pullback from this high right here, this candle, all the way down to 35. That's a 39% pullback from your calls that you have. So why are you going to let your long-term calls pull back 40% basically from the high, you know, when you can protect yourself and make that money back with those short-term puts? Okay, so from this day right here, when you got that first candle below the previous candle body, you're at $53 a contract. You know, you're in for 26. So even from 26 to 53, 53 divide that by 26, you're still up 104% right here. So it's either A, you could close out these SPY calls for 104% gain, close those SPY calls out, and then enter into the SPY puts. Or if you want to hold on to this, you're holding on to it, and then you're initiating that SPY hedge. Okay, and like I said over here, you're looking for areas of consolidation, right? We were talking about consolidation, support, resistance areas. And last week, if you guys looked at that video, nonstop, I was saying, guys, this is really important here. We have base support right now at 333 a share on SPY. Okay, I was saying if we hold that, we're going to be holding on to our long positions. If we fail below that, that's when we're going to be entering into some more SPY puts and closing out our long calls. Because the general market had a 7% pullback. You know, it actually went down 10% on NASDAQ, which is considered correction territory. So again, markets pulled back about 7 to 10% during this retracement period. So what you want to do is to be able to take advantage of that pullback with these short-term SPY hedges. Okay, so let me clear this out here. So again, side by side here, you could see we made 140% gain on that short-term SPY hedge for September 16th. If it was September 11th expo, that Friday's expo that we got in at 9.3, and then we said, hey, we'll get something out for, what, 9 days out, 8 days out till expo? 8 days out till expo was perfect. That's why we picked up the September 11th SPY puts, and we closed those out for massive over 200% return. But what's important there is that retracement period. It's either A, you got to cut your longs, or B, you got to protect your longs with those short-term SPY hedges. Last week, the account did not pull back last week. I was actually up, I think, about $800 for the week during this whole pullback here while the general market was pulling back. And that was because those SPY puts saved the account. You know, if I didn't have those SPY puts, I'd be down thousands of dollars last week. But during that time of retracement, I ended up walking away with a profit because we were properly hedged against our long calls. And now that the market's climbing, you're seeing the gains that we're having today, up, what, $2,100 today. You know, and that's from our NVIDIA and Tesla trades. And now tomorrow that UPS trade is going to be rocking higher. And that was a piggyback trade. So now that's what's important here with those hedges, is taking advantage of those short-term pullbacks. The SPY pulled back 7%, and your calls that you have ended up dropping from 56 all the way down to $35, a pullback of 37.5%. So your goal with that hedge is to protect your long positions during a short-term retracement back down to support areas. So that's really important, guys. So that was really important, guys. That long call there that you had on SPY was up 119% really from 57. You got in at 26 and went all the way up to $57. 119% gain. That first signal that you had that the markets were pulling back and retracing down to support, like I said, it's either A, you lock on those profits, or if you're still bullish, you gotta protect your account. And those SPY hedges are a perfect way, because after this presentation's over, I'm going to show you some examples of those SPY hedges there, because SPY is still continuing to break down, and you have to take advantage of those short-term pullbacks. So now let's take a look at the next screen here and see what's going on. So now you have success with hedges. You made it. You were able to profit from your long calls as well as your short-term profit, as well as make a short-term profit with the general market pullback back down to those support areas. And if you guys remember, last week we were talking about that 333 being an important support area on SPY. I was telling you guys consistently, and this is why it's so important to listen. When I say, guys, now's not the time to be trading. Now's the time to be watching the market. We're in an area of consolidation, and it's either A, we're going to be breaking below that 333 support on SPY, or B, we're going to be climbing. And if we break below that 333 support area, then we're going to be exiting our long calls and adding to our SPY puts. So at first, we just had that SPY hedge with that short-term SPY put. But if we broke below that support, we'd be exiting our calls and then also be adding to some more SPY puts. So that is going to conclude the hedging your positions, profiting when markets pull back presentation. Now I want to go back to the chart here and show you guys a little something. Okay, so when I have this, I was telling you guys about SPY. If I was able to show you guys SPY, I'd be able to show you guys the September 11th expo, which was a huge gain. But obviously, as you can see, I can only go back to September 16th. Now, again, I noticed something I did wrong here. Back on that initial entry here, when the stock's at 316, 317, instead of going with that 310, we should have been going with that 320. So with that 320 strike call for that December Expo, you're going to be able to see this here. The January 15th, 2021. And if you look at that 320, that 320 call right here for January 15th, again, on July 10th here, if we go over to July 10th, this was worth about $19.84. We'll just say 20 bucks. It was worth $20 a contract for that SPY 320 call when you got that crossover, the MACD, and confirmed breakout. $20, and went all the way up to 49. 49, divide that by 20, that's 145% gain on those calls. But take a look. So if we're saying $48 all the way down to $27.50, you just lost $1,300 or more like $2,000 from $47.50 down to $27.50. You know, just one single contract that you picked up for $20, that was $2,000 for one contract. So if you picked up that one contract for $2,000, it went all the way up to $4,800. You know, so you got a $2,800 net gain there. So to protect that $2,800 net gain, that's why you're using those short-term SPY puts to protect yourself on this downside right here. Because if you didn't, you just lost $2,000 on that pullback on SPY. That's a big hit. So you were up. You got the trade for $2,000. Now it's at 31. You're only up $1,100 now. Before you're up $2,800. So it's important because it's protecting you on the downside, and you're going to be making profit on the downside. Now, what's the beauty of it is, if you see that SPY, look over here at SPY on the left here. Let me get up my annotation. Now, here's your area of resistance right here, and it's going to be right about 345. So if we could get a green candle above that 345, we're going to be adding to our long calls there, because then we're breaking that resistance area. And now that we took short-term advantage of that pullback in the market, now it's getting up to that 1020. So you have to be cautious, because if it fails at that 10 and starts to head lower on that next red candle below 340, that's where you're buying more puts and looking at that 333 as that next area of support. So if you get a candle tomorrow that's below this green candle here, that's an area of short-term put entry as a hedge. And that's really important to understand that, because you could see where you're at right now. So if I zoom in right here, you could see on this SPY chart, we're getting right up to that 1020 right now. We didn't break above it yet. We're right at it. So when we're entering into breakdown momentum, you guys know that we'll get up to that 1020 and then fail and head lower. So right now you have to understand a major thing here. And this is all to help you guys protect your account. Your MACD, you got your cross below. There's check 1 for a put. Here's your 1020 cross below. That's check 2. Your next red candle is actually your confirmed entry into breakdown momentum and a confirmed put entry. Okay, so you got 2 check marks right now for SPY puts. The next red candle below 340, that's going to be your entry. So if you get a red candle tomorrow, that's going to be your SPY put entry. And that's really important to understand that, because right now you're getting up to that 1020, but you're failing. But we really didn't fail yet, because the market's up almost 1% today. So if we get a green candle tomorrow and we break that 345, I'm going to be adding to some long tech. I'm going to be adding to some other, we'll probably see a good sector rotation here coming ahead of the election. So I want to make sure that we're looking for some, that's why we've been bringing up the heat map. That's really important. Let me bring that up for you guys here. That's why it's so important to always be looking at this, because if you take a look at this heat map here, let me see where the heck I put it. So if you take a look at this heat map right here, let me get rid of that drawings. This is going to tell you all the information you really need to know. This is telling you your sectors, your consumer services, your consumer cyclical, your consumer defensive, your tech sector, your financial sector, your healthcare sector, industrials, real estate, utilities, your energy, your basic materials. And this is going to tell you everything you need to know. What sectors are hot, which ones are not, which ones are pulling back, and where you could find advantages. And if you see tech is still continuing to take on, look at tech. The NASDAQ's up 134 points today, 1.21%. That's really important to notice that and say, hey, I'm going to be trading tech now. If you see everything's green but tech is all red, well, heck, that's a sign of a sector rotation coming. That huge breakout we had in tech sector, well, that might be finally starting time to retrace and come back down to support. So you obviously don't want to be buying tech calls there when that sector is pulling back. So that's really important to be watching the heat map and seeing everything that's going on and being able to utilize that to your advantage. So again, this 333 is a major support area on SPY. If we get a red candle below this, the market's going to have an even bigger pullback. And if we do break below that 333, I honestly think we're going to see about 320, which is going to be another almost what is that? Almost an 8% pullback again if we come down to 320. After that, we're looking at 300. So if we come down to 300, that's about a 13% pullback from where we're at now if we drop down to 300. So that's why it's so important and critical during times of, consolidation, during times of instability in the markets. Sit back. Don't be actively trading. Don't be forcing trades. The worst thing I see in the trade room is when you'll see a lot of new members that just sign up, hey, let's make some trades today. During certain times of the market, you have to be waiting and either A, looking for that sector rotation, or B, protecting yourself for the downside. And like I said, if you are long calls, if you're long shares, if you're long anything, you can protect yourself on the short term there with SPY. And the beautiful thing about SPY, I love using SPY as short-term hedges because look at how many expos you have. You have 3 expos every single week. September 16th, 18th, 21st, 23. Every other day you have an expiration. So if you get that first signal of that big candle and you get something 3 days out, well, heck, that short term. So for example, right here, the market pulled back, I'm pretty good at math. So from 356 down to 333. 356 minus 333 is 23. Divide that by 356. That means the market pulled back 6.5% right here in those 3 days, right? So now watch this. If we pull back 6% from right now, that's another what? 356 minus 333. So let's just say another 23-point drop. So 340 minus 23. So let's say we get down to 317 on SPY, right? So if we go from 340 down to 317, 340 minus 317, that's 23. Divide that by 340. That's a 6.8% pullback. Okay, so now I want to show you on using this how that works for the short-term SPY hedge here, using a realistic real-time example here. So now let's say that you're saying tomorrow we get that red candle and we start to drop and you're like, okay, another pullback's coming and I want to take advantage of another SPY hedge. What are you going to do? You could get something a couple of days out. Let's say September. What is this week's expo down here? Let me see. This week's expo is, I think, the 18th, right? Yeah, the 18th. So let's just say you got something for this week's expo and the market pulls back 6.8% in the next 3 days, right? Just like it did right here. We're just using the same scenario of this happening for those 3 days as it might happen tomorrow for this example. So let's say we buy the 340 strike puts here on SPY, and they're going for about, you can see right here on the put side, these puts, let me get my annotation up. Okay, so for the September 18th expo, these puts, the 340s, are going for theoretically 3.33. Okay? So that 340 strike put is going for $3.33 a contract. So if we pulled back 6.8%, that brings us down to $3.17 a share, right? So if we're at $3.17, obviously the difference from 340 to 317, that's going to be what these contracts are going to be worth. So 340 minus 317, that means these contracts are now worth $23. Guess what? Your $333 for a single contract is now worth $2,300. That's 23, divide that by 3.33. That's a 591% gain if the markets had another short-term pullback here for the next 3 days like it did right here. So if SPY pulled back for 3 days like it did for those 3 days and got down to about 317 there, that looks weird. But if it pulled back there, let me clear that off. That I'm horrible at drawing there. So if you have another 3-day pullback like that, oh man, I can't draw a straight line at all. It's this desk. But like I said, if you have those 3 days of pullback there and you want to take advantage of that, this mouse must be dying. That's definitely not me. So you want to take advantage. Another 3-day sell-off just like that of about 6.8%, that brings SPY down to 317. These short-term puts right here, if you picked up the 340 strikes for $333 for one single contract, let's say you got 10 contracts. If you got 10 contracts is going to cost you $3,333, right? $3,330 for 10 contracts. Well, if we drop down to 317, those 340s minus 317 are now worth $23. $23 multiplied by 100, multiply that by 10, that $3,300 is now worth $23,000. So that $3,300 SPY short-term put hedge is now worth $23,000. And guess what? If you had 25% of your long positions into that short-term SPY hedge and you pulled back that 6.5%, 6.8% again, that's going to be a hell of a savior for that account there from taking 3,300 into 23,000. So that's the importance of those short-term pullbacks. In the example I went over in the presentation, I used the example for September 16th because that's the shortest expo I was able to use. If I was able to make this class back on September 11th or September 10th and show you guys, you'd be able to see that those short-term SPY puts here paid off well over 600% gains. Well over that. Like I said, if these got up to 23 and we paid $3.33 for them, that's a 591% pullback, and that's with the implied move now in there. Back here, this implied move isn't raking up those option premiums much more yet. But once you start seeing these candles, then the implied move is going to that's going to skyrocket these premiums up much more once that implied move becomes higher. So that's the importance of getting in on that first time you see that candle below the previous candle's body and wick. Because right here is where you want to be entering, somewhere right in between here. You're below the body, you're below the wick, and if you have that short-term trade, that's when you're going to be taking advantage of those puts. And that short-term put there is really going to help your long-term calls. And then you get to decide the next day, okay, now I got a nice profit on these SPY puts. And you guys remember, I was sharing with you the profits we were making every day last week. We had 2 days last week where I was down a couple of dollars because I should have added a little bit more of the SPY puts. But 3 of those days I was up thousands of dollars because I was utilizing those short-term SPY hedges against the long-term calls. And the nice thing about that is now, like I said, our UPS trade that we were down, I'm looking at the account right now, the UPS trade, I'm down 47% on that on the close of today. And that sucks. I was down 47%. But you know what? You're looking at that UPS trade, we knew what we were looking for, and that's the importance of it. You know, we knew we were holding that base support right around 157. We knew it was a piggyback trade off FedEx earnings. You see what FedEx did. That's why it's so important when we say, hey, let's do a piggyback trade on something. FedEx calls were crazy expensive because they were expecting an 11% implied move from back here to earnings. So I think it was like 6 days until earnings when we looked at that. And you could go back on the videos and check it out. But when I showed you guys the implied move on FedEx, it was 11.11% that they were expecting. And I remember saying, guys, that would bring us up to about $250 a share. We were right around 223, 224. And I said, guys, if that has that 11% move, we're going to be at 250. And we looked at that out of the money vertical spread on FedEx and we said, hey, you know what? I think it's got a max gain of 200 or 300%. We could have made that. But that UPS trade, it had low implied move because it didn't have earnings, and we were able to do a piggyback trade off of it. Obviously, the two companies are in the same sector, so why pay so much more for something like FedEx because it's expecting earnings when we could jump in UPS when it's not expecting earnings, and that option premium is much cheaper? So that's the importance of looking at your sectors, because you could see during this time of this pullback here from September 3rd until now, September 3rd over here, we've done nothing but climb with FedEx. Here's September 3rd, we've climbed. So you have to understand there's different sectors that'll continue to climb even when the general market's pulling back. And that's why you got to constantly be adding to your watch list and looking for those stocks and those sectors that are starting to take off when the general market's pulling back. Because if you're long technology here, and then you got some nice gains on those tech calls that you have, and then that first sign of retracement, you get that SPY put hedge there, and you start making money on those SPY puts, and then you're like, yeah, you know what? It looks like tech wants to start selling off. Well, you know what? Then you're going to take your profits on those tech stocks there, or the tech calls that you have, or SPY calls, whatever it is you have, and then you're going to reshift and reposition your portfolio to either A, take advantage of the general market pullback, or B, that new sector rotation that people are now jumping into. So that's really important, guys. And I want to make sure that you guys know the importance of hedging. The whole point of hedging is taking advantage of these short-term pullbacks with a short-term expo against your long-term calls. And when you have that little quick 6-7% pullback in the market, that's when you could take that $333 into, $2,300, or take that $2,000 into $25,000, and we've had members that have done that, and, they'll get into quite a bit of contracts. They'll make a $2,000 trade here. And then 3 days later, like, Dave, I made $30,000. What do I do? And that's the advantage of buying those short-term puts. And you guys could scroll up in the trade room and look back last week. Last week, I got so many messages from members telling me that their accounts were at new highs, because when I was making the trade challenge trades with those SPY puts, obviously the people with smaller accounts, they were jumping into those SPY puts because they were trade challenge accounts. So when they were jumping into those trade challenge accounts with those short-term SPY puts, there's a lot of members that took their accounts to new highs and new levels they've never seen before, but it really comes down to properly managing your long positions with these short-term hedges. And if you're doing it properly, even times of retracement in the market, you're still going to have some nice profits, or at least protect yourself from the downside. And if you see, hey, the markets are pulling back, but those SPY put hedges aren't making enough as the SPY calls are losing, then obviously you got to add a little bit more to make that a successful hedge there. But that's what's important. And the basics of that SPY hedge are about 25% of your long position. So if you have $1,000 call here and you're still holding on to those SPY calls here, then you're making about a $250 SPY put. So one single contract would be fine for that retracement. And then if you break that 345, that's when you could be adding to that SPY call, to make it simple. So that's going to conclude these hedging against the market and hedging against shifting markets here. If you guys have any questions, I'm going to ask you guys to please type it in the trade room right now, and I could go over that with you guys. And again, please keep it limited to questions on the topic. So I'm going to go in the trade room now and see if you guys have any questions. Okay, so Ron says, when do we do a longer term put since we got the two crossovers? That's a great question, Ron. So again, now let's say you have that short term hedge right now still on, right? Let's just say you're still on, and now tomorrow you get that candle below 340. Well, if you get a red candle below 340 tomorrow, that's when you're going to do a short term put hedge, maybe for this week's expo. Right now, if you come and you drop below this 333 support that we were able to hold on that first breakdown, if we're able to hold that 333, we're good. We're golden. But I'm telling you right now, if we break below that first initial breakdown here of support at 333, the general market's going to have a much bigger pullback because number one, you're going to have your first red candle below that 50 SMA. And if you zoom out here, SPY during this whole breakout momentum cycle has not had a single darn candle below that 50, red 50 SMA. So if you see that candle break below that 333 support on SPY, that's a sign that, hey, I really got to watch this market shifting here. I got to close out some of those longs or reposition and do a sector rotation here, or B, buy those SPY puts at, if you break below 333, you buy those SPY puts for, like I said, Ron, remember when we did our class together? So the first initial cycle, what are you doing? How long's your expo on a new cycle? You're getting an at-the-money strike call or an at-the-money strike put, depending if it's three months out, 3 to 6 months out, Ron. Yes. 3 to 6 months out until expiration. So if you got a new cycle forming here and you're entering into breakdown momentum and you get that next red candle below 333 support, get something 3 months out till expo, something that's going to cover you during the election, and then you're going to be golden, and then you're going to be looking for that next support areas. And that's where you'd be taking profits. So you got some pretty decent support right around 320 and then 300. So target profit 1 would be 320. Target profit 2 would be 300. And the nice thing about that is the reason why I say that is because, if you got 10 contracts, well, sell 5 of them if you drop down to 320. Lock in those profits and lock them in at 320. And then if you continue to pull back there, then that's when you could take advantage and add to it and look for that 300 as the next support there and really see those massive gains come in. So that's a good question, Ron. When do you get a longer-term SPY put? And the answer to that is when you see that cycle give you that third check mark. Right now we have 2. We have the 1020 cross. We have the candle. We have the MACD cross. Right now we're looking for that red candle. And most importantly, what I'm looking for is that candle below 333. Candle below 333, and the markets are going to be shifting and heading much lower. So that's what we got to be looking for now going forward. So now the whole point of you guys being elite yearly members and the pro traders is in the afternoon, I really don't want to look for more trades in the afternoon. What's important for you guys to understand is managing current positions. I see too many of our members and too many new traders, they just want to constantly buy. And then I see members saying, Dave, I'm in 23 positions here. What do I do? If you're in 23 positions, first off, you got to step back from trading because I'm sure as heck that you don't know your target, your stops, your resistance, and your supports on all of those 20-some positions. Okay, so it's really important to manage your trades. Don't always be looking. If you find a nice breakout, that's fine. But don't constantly be looking in the same sector because once you get that sector rotation, the stove's turned off. Yeah, it was hot for a while. You made money on it. But, now you gotta shift. You got to look for something else. So that's what's really important. And this SPY, that's what you got to be looking for right now. If we get that candle above 345, we're going to have another nice breakout and be climbing into the election. If not, we're going to be failing and heading down to those old support areas. These support areas were once resistance areas. So that's really important. Okay, so Beth asked a great question. Dave, I'm unsure of where I am to find support areas. You say 320 and 300, but I can't see it. Okay, so if you could see here, let me get my annotation up. So if you could see here, look at this area here of all those candles right here. And then even back here, is pretty easy to identify this. You had some areas where the stock climbed and it failed to drop below. It failed to drop below. So these were support areas going way back from July to August. So this is an area of consolidation, which is showing you that support area. So that 320 is that support area going back to July and August. So that's support one. So when I say S1, that's S1. Now the next big area on SPY, obviously you got some support right at around 310, but nothing major. What I'd be looking at is that 300, and that goes all the way back from May, June, July, and that's going to be an important area. So when you're looking at those support areas, this is the area that you want to be looking at profits for those longer term puts. So if you have the markets changing cycles now and you're going from breakout momentum to breakdown momentum, well, first off, you already know what you're looking for. Those 3 check marks. You're looking for that 1020 cross, you're looking for that MACD cross, and then you're looking for that first red candle below support here or below 1020. If you got one tomorrow, a small little one, you could do a short-term put for this week's expo. But what I'm really looking for is that 333, because you saw when we had this heavy breakdown here, we held that 333. So being that we held that 333, that's going to be support one. So S1 is at 333, S2 is at 320, and S3 is at 300. So for that short-term put, you'd be looking at 333. If it drops to 320 from now until Friday, obviously that short-term put's going to make you a 500 to 1,000% return because of that big drop there. So that's what's really important to watch. Now, if you got into that put tomorrow, if it had a red candle and it dropped and you said, okay, now's my time, I want to jump into that short-term put, and you got this week's expo, well, then obviously once you get down to that 333, that's an area where I'd take profits and then either A, look for another SPY put for either 3 months out, 6 months out till expo, or B, looking to either add or close out some other positions there. So that's what's really important. Does that help you out there, Beth, a little bit? Great. And guys, always during the trade room, ask questions. I'm honestly, sometimes it's sickening just looking at stocks all day. Sometimes it's good to go over account management, trade management. And those are important lessons throughout the day that we could be doing in the afternoon pro trader session. Those are really important times to say, hey, Dave, you know what? That UPS trade we're in, it's down 47% right now. What are we looking for? And we could be going over it. I could be showing you guys the implied move on FedEx compared to UPS, showing you guys the implied volatility and the implied move with the option premium of UPS versus FedEx. And you'll say, wow, that's really expensive compared to UPS there. So it's really important to manage trades, manage your account, and protect your gains, protect your value in your account. And you're going to do that with those short-term hedges there. And if you're successful, like we were last week with our hedges, you'll be able to see the account even climb during those times of retracement there. That's when we took that trade challenge account up to about $9,000 was when we had that pullback there. Those SPY puts paid off huge for that trade challenge account. And that's when you were seeing so many people in the trade room say, wow, Dave, I just joined you. I have no idea what I'm doing, but I took 5,000 to 30,000. Because when I'm jumping into those short-term SPY puts, that's what I'm doing. Unfortunately, they're not utilizing the 25% rule. They're probably just jumping into some SPY puts and making a heck of a gain on the downturn since they're new traders. But, that's what's going to help you on the downside. So when you see that first candle below the previous candle's body and wick, and then you say, oh, wow, look at the size of that candle as well there. That size of that candle on SPY here is 5 times, 6 times the previous candle. That's showing you that there's a hell of a lot of volume coming in there. And there's a lot of selling pressure coming in. And if it's happening one day, that's going to spark a little bit of fear and panic, and you're going to see that continue for a few days. And like I said, now tomorrow, what's important? Are we going to hold that 1020 and break above it and break that 345? Because 345 is going to be the next resistance that we're going to see. Okay, so if we could break above 345, we're going to be adding to some tech stocks. We'll be adding to some other sectors that are taking off there. and we're definitely going to be taking advantage of the markets. Now, if we have a red candle and we drop below, if we drop below 340 tomorrow, I might get into some puts there. But what I'm really looking forward to is if we drop below 333. A drop below 333, we're getting puts for 3 months out till Expo. We're getting a slight out of the money put, and that's when you make your bigger trades, because then you're shifting cycles. You can see this whole time here we're in breakout momentum, right? Okay, so now if you get a red candle tomorrow, that's officially breakdown momentum. So if you start to break down momentum tomorrow, that's going to be your first candle, and that's right near the highs you're able to get in. And then if you do drop down to that 300 support, well, you know what? You made a heck of a trade there with those SPY puts, and that's from entering into that new cycle. And then obviously, depending on who wins the election, we could easily see a pullback down to 280 even. All depends on how the economy is and what happens with this election. So I really hope tonight's class helped you guys on proper hedging and when to hedge during a shifting market and how to protect your long positions. And if you guys have any questions, let me know. PR Dub says, great class, Dave. Learned a lot today. Thank you. And guys, we're going to be having classes every week now. So if I'm not very active in the afternoon one day, it's because I like doing quality work. I want to be able to make quality presentations for you guys, make it simple, easy for you guys to understand, and give real-time examples, because there's nothing like real-time examples to show you guys what to be looking for and how to protect your accounts. Amy, so we look at daily charts for swing trades and minute charts for day trades. And guys, now if you guys want to let me know what you guys would like the next class topic on next week, I'd really appreciate you going in the trade room and giving me some details or some ideas of the next class topic. And really think of something that would help the general room there. And I'd love to cover that next. Alrighty, guys, that's going to be it. This class is recorded. It will be uploaded, and I will be posting this on the site once it's done in editing. Alrighty, guys, take care. Have a great night.